Welcome back. Now, the performance of the market has been weak in 2018 as the equities market had recorded a decline of 13.2% year to date. With earnings season here, we will be discussing the general performance of companies and further analyzing the potential impact on the market. Also, the medium-term expenditure framework was recently released by the Budget Office of the Federation. All of these we're going to unpack in this session. And joining me to put all of these together is the Head Investment Research at Afrinvest Securities, Robert Omotunde. Good morning, Robert. Good to see you.
Good morning, Chimeze.
Right. So we've seen the 9-month earnings season, here, and a number of companies are already churning out their numbers. How would you describe the performance so far?
Well, we think the performance is in line with expectation. I mean, coming from the performances we saw by the half year, and the general performance of the economy, we expected some of the numbers we've seen, even though we've not seen the bulk of the third quarter earnings season. But for the corporates that have released, particularly the quality corporates within the banking space, GT and Zenith in this case, and of course the biggest of the industrial goods space, that's the Dangote Cement. We've seen their 9-month result, and what we could say for the banking industry, for example, we're seeing a performance where top line, is not as strong, as you would expect. I mean, coming from the performances they recorded in 2017. I mean, this is 2018, and we're seeing the 9 months. Zenith, for example, was down in terms of top line gross earnings, but we saw GT, still managing to post positive earnings. But again, the bottom line, is something to interest in the banking space, but when you look at the industrial goods space, we're still seeing a very strong performance, looking at what Dangote Cement was able to churn out double-digit growth in revenue, as well as double-digit growth in profitability. Still speaks of so much of opportunities existing within that space.
Now, which sectors would you say have been the most exciting so far since the commencement of this earnings season?
If I look at the two sectors which I mentioned, the industrial goods and the oil and gas, but because we know some of the peculiarities of industrial goods and the banking sector, not the oil and gas, I beg your pardon. When you look at the peculiarities of the industrial goods, for example, look at the counters within that space. You have Dangote Cement, you have WAPCO, and then you have some other chemical, and allied paint producers. The quality one within the space, we've seen the corporate release their results. That's Dangote Cement, and the performance was quite good. And if you put that into context of what to expect, between now and going into 2019, looking at some of the challenges, the economy is facing and the need to grow our infrastructure base, we would expect some positive performance. So clear winners, I would say, will still be the banks, given that they've displayed this resilience over the period. We've seen, like I mentioned earlier, the quality banks, but for other tier 1 banks that are yet to release, we're positive. The likes of Access, UBA, we're positive on what numbers they're going to channel. So I would say that the industrial goods and the consumer goods definitely are the winners in the numbers that we've seen so far.
Talking about industrial goods, well, WAPCO recently released its results, and that result didn't seem to impress the market. For you, as a market analyst, how do you see that result, and what do you think would have contributed to such a result that was churned out by that company?
Yeah, WAPCO has a peculiar challenge, when you look at their place within the cement industry. WAPCO plays in the same industry where Dangote Cement is, even though they have their own competitive strategy. But over the last 2 years, we've seen this drag in performance, particularly in revenues and of course earnings, and again, you could trace this to maybe the competitive strategy of the major player in that industry. Dangote Cement, for example, looking at its efficiency drive, especially at the EBITDA level, the operating level, as compared to what you will see from WAPCO, But again, we want to believe that management of WAPCO is definitely looking at this, even though we are not so positive in terms of the earnings outlook for them, over the next 1 year. Perhaps for us, WAPCO is not a buy, at this time, looking at some of the performances and some of the drag to their earnings.
Now, the Senate recently approved the borrowing plans for the government for the 2018 budget. That is believed to impact on capital spending. So how much of impact will this have on the industrial sector? Well,
again, you look at the budget numbers and the amount to be spent on infrastructure, from the perspective of construction, to be specific, and you see the place of Dangote Cement, in this particular sphere. But again, the worry for us will be, the much that can be done, given that we are going into an election, and up till now, of course, the proposed plan to borrow was approved by the Senate, and in a couple of weeks, we're expecting that the DMO, Ministry of Finance, will be approaching the international debt market, the Eurobond market, to be specific, to raise these sums of money, But the impact on the industrial goods may not be felt in this fourth quarter that we're entering into. So perhaps we'll begin to see this. Again, spending on capital projects, for the 2018 budget is allowed to slip even into 2019. We only hope that these monies are directed at, as proposed, so that they are not affected by the elections that we are going into. But again, the impact on the performance of the industrial goods will be much more in 2019 than in the current 2018 financial year.
So what are your expectations for the rest of the earnings seasons? Are there likely to be some surprises from companies yet to release?
We are not expecting any surprises. Again, you look at the lull in the general macroeconomic space, the weakening consumer spending power, this will likely affect the consumer goods space, so performances are not expected to particularly excite. The industrial goods, the major factor that should drive, their performances fundamentally, is one of the constraints is the budget, which we just mentioned. Perhaps the only bright spot we're seeing is still within the banking space, which again, given what we've seen so far in 2018, we've seen that some of them are slowing down, even though we're seeing some improvement in deterioration of risk assets that was recorded in 2017. We are still not expecting that there will be significant performance. So what you will likely see is a drag in top line, but some efficiency put in place, because we've seen reduction in operating expense, for some of the banks, so cost to income ratio is moderating. Again, the top line is largely being affected by interest expense because of the competition amongst the banks. Of course, given that the yield environment is also moderating, so banks, are struggling for deposit, and they have to, up the interest rates, in order to attract depositors. So all of these factors, again, would be expected to drag the performance of the banking sector, but they are still clearly expected to do better than most of other sectors. So no any surprises.
Let's look at the overall market. What are your expectations before the year end?
So we've seen the initial drag to performance, which was the normalization of policy, within global systemic central banks. Added to that is the fact that we are approaching elections. You're already seeing all the politicking. So most foreign investors are trying to be wary, of taking a very significant position in the market. So what we've seen recently is that some investors have even, moved out money significantly, and we still expect more of this to come, before the end of the year. Ordinarily, you would expect some, gyration in the market after GT and Zenith released their results, which were not bad, especially when you look at the earnings. But we've not seen this significantly because most of the foreign investors that, invest in these securities, are sort of sitting on the sideline, and just watching. Perhaps what we will see will be towards, when the elections are finally over. We are hopeful we can wait, because business has been so slow, especially on the equity side. So perhaps that's when we'll see some improvement.
All right, and what are your views on the current yield environment? Are there likely changes to current dynamics you foresee in the horizon?
Yeah, there have been calls for increase in the benchmark rate, for example. Of course, given that in the developed markets, we've seen improvements in yields. The calls have been that we need to attract, more investment. But we believe that the central bank, as we move gradually towards the elections and as the pressure mounts, for capital flow reversal, we may see some appreciation in rates, towards the end of the year. Purely market-driven, not from the perspective of a tweak in monetary policy. We feel that the MPC will just maintain the status quo. But the current yield environment has been sort of calm, it's on the high side, especially for the bonds. When you're looking at the above 2-year term to maturity, mostly within the bond space, not, of course, on the treasury side, you're still seeing, some slow, momentum. So what we see happening now are some of the investors, trying to just, identify, the attractive yields within the, the sovereign bond yield curve and taking position in expectation that after the elections are over, yields will gradually trend downward, and then you see some appreciation, you can book some, capital gains. But generally speaking, the yield environment is calm right now and not much of opportunity for arbitrage.
And looking at the medium-term expenditure framework that was released recently, how do you think the plan for that 2019 budget is going to drive the market sentiment going forward?
Well, we saw this, happening some days ago when the Minister for Budget and National Planning, in their engagement, they're trying to engage with the stakeholders, in looking at the medium-term expenditure framework, and of course, particularly the budget for 2019. But from the numbers we've seen, apart from the fact that government expects to spend about 8.6 trillion in total expenditure, the lines and the assumptions, underlying most of the numbers that have been rolled out is still much in line with what we saw in 2018. And these are concerns for us, especially when you look at the revenue lines of government. Government is expected to raise about 7.2 trillion. I think 7.9 trillion to be specific. That's in 2019 budget. We feel this is still unrealistic, given the current, revenue profile of government. And when we look at the assumptions, underlying this, we also see that the possibility of, achieving this target, is perhaps very slim. And what this will imply is that fiscal deficit, will still be on the rise. There may not be borrowing, as the government is now trying to watch because of, different concerns. But the issue will now be that you may have some financing of the budget, from the central bank quarters, if definitely the expenditures must be met. So the performance on the market is expected to be muted, given that even the 2018 budget, we've not seen much of implementation, talk of the 2019 budget.
But the current gains we have seen in the market so far, since this week, how long do you think that will last? Are we likely to see the market up for the rest of the week at least?
We feel it will not last. Because the assumptions, the factors driving the fundamentals or driving sentiments, are still much in line the same. So what investors are just trying to do now is to identify some, counters. You see that some of the bellwethers, were the ones that, posted significant gains yesterday. They will identify those opportunities and, of course, take the profits as time comes. But when we expect the entire sentiment to change, when we expect a change in tide will be towards after the election, post-February 2019.
Okay, we'll just wait and see.
Thank you.
Thank you, Robert.
Thank you.